Most people buy insurance, but almost nobody truly understands it. Every year, Americans waste over $40 billion on policies that don't protect them and lose claims they deserve to win. In the next 9 minutes, that changes. Here is the fundamental truth that insurance companies hope you never learn. Insurance is not a savings plan. It is not an investment. Insurance is a bet. You bet that something bad will happen. The insurance company bets that it won't. And they have a century of data telling them exactly how to price that bet, so they win more than they lose. Every premium you pay goes into something called a risk pool, a massive shared fund that covers claims across millions of policyholders. When you file a claim, you are drawing from that pool. When you don't, which is most of the time, your money stays in the pool and the insurance company profits from the difference between what they collect and what they pay out. This is not inherently unfair. The system works because risk is real. Your house really could burn down. Your car really could get totaled. And without insurance, a single catastrophic event could financially destroy you. The problem is not the concept of insurance. The problem is that most people don't understand the product they're buying, and the industry counts on that ignorance to maximize profits. The first rule of insurance is simple. Insure only what you cannot afford to lose. A $500 deductible on a minor fender bender? You can handle that. A $500,000 hospital bill after a serious accident? That is what insurance is for. Life insurance is where the insurance industry makes some of its most profitable sales, and where consumers make some of their most expensive mistakes. There are two main types of life insurance, and understanding the difference can save you hundreds of thousands of dollars over your lifetime. The first is term life insurance. You pay a fixed premium for a set period, say 20 or 30 years. If you die during that period, your family receives the death benefit. If you don't die, which again most people don't during the policy term, the policy expires and you receive nothing. It sounds brutal, but term life is actually the smartest choice for the majority of families. Why? Because it is affordable. A healthy 35-year-old can get $1 million of coverage for as little as $40 a month. The second type is whole life insurance, also called permanent life insurance. The pitch sounds compelling. You get lifelong coverage and your policy builds cash value over time. Sounds like an investment, right? That is exactly how agents are trained to sell it. But here is what they don't always tell you. First, the premiums are dramatically higher, often 10 to 15 times more than term. The returns on that cash value component are typically 1 to 3% annually, far below what you would earn investing in a simple index fund. Third, if you need your money and borrow against the cash value, you pay interest on your own money. The classic financial advice is simple. Buy term and invest the difference. Take the money you save on premiums and put it into a low-cost index fund. Over 30 years, that gap compounds into a significant wealth-building advantage. For the average American family, term life is the clear winner. Auto insurance is legally required in 49 states, which means the industry has a captive customer base. The average American pays over $2,000 per year for auto insurance. But studies consistently show that people who shop their policy every 12 to 18 months pay significantly less, sometimes 30 to 40% less, for the exact same coverage. Here's what most drivers don't know. Your credit score directly affects your premium in most states. Improving your credit score can lower your insurance bill by hundreds of dollars a year. Your zip code also matters. Urban drivers pay more than rural ones. Practical tips that save money. Always bundle your auto and home policies. Discounts of 10 to 25% are common. Raise your deductible. If you can afford to pay a $1,000 deductible out of pocket, do it. Ask about every discount available. Safe driver, good student, low mileage, and vehicle safety features all qualify. Health insurance is arguably the most complex financial product most Americans ever buy. A single serious illness without adequate coverage can result in medical debt that follows you for decades. The premium is what you pay monthly to keep your insurance active. The deductible is what you pay out of pocket before your insurance kicks in. The out-of-pocket maximum is the total you will ever pay in a single year. after which your insurance covers 100%. The critical decision most people get wrong is choosing the cheapest premium without reading the deductible. A plan with a $100 monthly premium might look great until you realize it comes with a $7,000 deductible. The Health Savings Account, or HSA, is one of the most powerful and underused tools in American personal finance. If you have a high deductible health plan, you can contribute pre-tax dollars to an HSA. That money grows tax-free. You withdraw it tax-free for medical expenses. Used correctly, the HSA is essentially a medical IRA, one of the few triple tax advantaged accounts available. Insurance companies employ entire departments whose job is to find legitimate reasons to deny your claim. The most common reasons: failure to disclose information when applying. The event was excluded under the policy language. The claim was filed late. If your claim is denied, you have rights. Request the denial in writing. Gather every piece of documentation. File a formal appeal. If the appeal fails, escalate to your state department of insurance. The number one thing you can do right now to protect yourself: read your policy. Know what is covered, what is excluded, and what the claims process looks like before you ever need it. Insurance exists for one reason: to prevent a single catastrophic event from destroying everything you have built. Take these 5 steps this week. Review every policy you hold. Shop your auto insurance. Check your life insurance type. Understand your health insurance deductible and out-of-pocket maximum. Open a health savings account if you qualify. If this breakdown gave you clarity, subscribe to Insure Smart. We publish deep dives like this every week. The knowledge you gain today is the best insurance you will ever buy.